we've got a conflict between these two systems, and it's going to get resolved. And it's as difficult as it all is, because we're all watching Bitcoin drop back. And, I just took a big hit on some of my gold stuff. Remember the Dan Murmacan Weimar chart, enormous volatility. I mean, it's going to be a volatile transition, but we know the direction we're going. This number go up compared to money that can be printed. And that's accelerating. My hair's on fire with these bond markets right now and the war. I mean, the other thing is, I don't think a lot of people have really fully discounted the impact of this war on supply chains and what's going to happen in the world. I mean, it's not just oil. It's all the inputs to many, many things.
Bitcoin isn't just digital gold anymore. It could become the money that powers global trade when traditional systems fail. Lawrence Lepard warns that rising debt, collapsing bond markets, geopolitical turmoil, and relentless money printing are pushing the world toward a monetary reckoning. As governments print their way out of crisis, Lepard believes Bitcoin could emerge as the ultimate escape valve, and its biggest move may still be ahead.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
So as we all know, the Strait of Hormuz is now shut, and idiot Trump, who got us into this, created that problem. But here we are. My belief is what he's going to do is he's going to declare victory and leave, and it won't be a victory. He's going to lie about it. He's just going to spin it as a victory. What'll actually end up happening, because I don't think he's willing to sink a Chinese ship, transporting oil out of there. I mean, we've closed the strait, but I don't think he's willing to call their bluff. Is they will start, and they've set it up. I mean, it's stunning to me, because Corey Clipston did a nice job of detailing on Twitter how it occurs. They've set up an insurance program, call it insurance or a bribe or whatever you want to call it, racketeering. But they're basically saying, okay, if you're say a Korean, person or Korean company that needs oil, your ship can pass through the strait, but you've got to pay a 1% duty on the oil. $1 a barrel, assuming oil's $100. And the only thing that we will accept is Bitcoin. We're not going to accept stable coins because Tether and Circle have been compromised, and those coins have been sanctioned. And we're certainly not going to do it through SWIFT. Well, they couldn't even do it through SWIFT if they wanted to, because Iran is locked out of the SWIFT network. And so it's pretty simple. You've got your ship. You want to come through. Here's the site. Here's how you communicate. Here's where you send the money via Bitcoin. Once we've received it, we say, fine, you're okay to pass, and you pass.
Yep.
And so, I mean, that's a Petrosat, right? I mean,
it is.
You were paying Satoshis to move oil through a critical juncture. And why does Bitcoin work in that role? Because nobody can control it. Nobody can sanction it. And this is the U.S. for years and years, decades and decades, has used the dollar as a military and strategic weapon to punish countries and others who don't, play by our rules or do things we want them to do. They sanction them. They grab the Russian reserves in 2022. I mean, all kinds of stupid shit we've done. And, basically countries have gotten smart and they figured out a workaround. Right? And so to me, I mean, there's no more impressive and obvious use case for Bitcoin. It's money that even our enemy can use to allow something to happen, and they will accept it. First of all, they've got a life expectancy that vastly exceeds that king, right? I mean, we should ask ChatGPT what life expectancy was in the 1600s in England, but I'd be shocked if it was more than 40 or 50 years. Average life expectancy was probably in the 30s.
I was going to say 35.
Yeah, it was probably 35 or 40 years. Wow. So in the 18th century, in the 1700s, average lifespan was 30 to 40 years. Wow. Even if you're poor today, developed country, got a pretty good shot at lasting more than 35 years. So things are getting better. But to bring it all back to the monetary situation that we're in, we've got a conflict between these two systems, and it's going to get resolved. And it's as difficult as it all is, because we're all watching Bitcoin drop back. And, I just took a big hit on some of my gold stuff. Remember the Dan Murmacan Weimar chart, enormous volatility. I mean, it's going to be a volatile transition, but we know the direction we're going. This number go up compared to money that can be printed. And that's accelerating. My hair's on fire with these bond markets right now and the war. I mean, the other thing is, I don't think a lot of people have really fully discounted the impact of this war on supply chains and what's going to happen in the world. I mean, it's not just oil. It's all the inputs to many, many things, fertilizer, helium, the list goes on. And when you choke off 20% of the world's supply of these things, and right now we're running down the storehouses, and we're running down the inventory. And I would recommend people check out Jeff Curry, who's an ex-commodity analyst at Goldman Sachs, or Craig Tyndale. They're both on Twitter. And they have really excellent analyses of how these supply chains are going to break, and the impact is going to be shortages. And we all know what happens in shortages. Prices go up. And prices going up isn't always inflation. I mean, if it's defined as a shortage, it's more of a supply-demand issue, but it looks like inflation. People read it as inflation. The bond market certainly reads it as inflation, and that's what counts. And so the bond market, if it continues to break, is going to force this, the powers that be to either, tighten to try and control bonds and return soundness to the money, but which is extremely painful, a very painful medicine, as Paul Volcker did it, or accommodate it and use, print more money, to have another drink to try and cure the hangover. Well, obviously, I've made the bet. We've all made the bet, and we believe pretty strongly that politicians don't think long term. They think about what can solve their short term issue. At the end of the day, they will print. And my belief is we're now in the real short strokes. I mean, this is probably going to happen sometime this year in 2026. There's also the interesting angle that so AI, to the degree that AI is legitimate, it's a productivity enhancer, right? You can do more with less. That's how we get better economic outcomes, is higher productivity, just doing more with less. And that's been true for thousands of years. And that's why capitalism works when it's really capitalism. And in the case of AI, as Jeff points out so brilliantly in his book, and what made it such a great book, a system where you're continually pushing towards more productivity and more efficiency doesn't work in a system that is built on more growth and making a number go up in terms of credit expansion and dollar expansion, because the one argues for deflation and the other requires inflation or else it blows up. And so the conflict between those two, it means that one of them is going to give. And I don't think AI is going to give. I mean, I think the productivity, if AI delivers real productivity, which I think it will over time, not as fast as some people think, but the credit system is going to come under increasing strain. Because what happens let's say it eliminates a lot of jobs, white collar jobs are replaced by AI. Well, all those people have car loans and mortgages and, and debts and expenses. And, now, I mean, I don't want to be a Luddite, because the fact of the matter is they will find other jobs, and all these, I mean, throughout history, we've been replacing bad jobs with new, better jobs. I mean, we don't have buggy whip manufacturers because we don't use buggies anymore. We don't have loom, operators because it's all automated today. But in the interim, the monetary system feels an enormous strain. If we had a deflationary monetary system like Bitcoin naturally gives us, this would not be a problem. We would have continually falling prices across the spectrum, and wages wouldn't go up. But real wages would go up, and that's what really counts, is that your dollar buys more, that you're able to live better, that each generation has an improvement in their living standards compared to the prior generation, right? That's the whole point of capitalism, and that's why, even today, I mean, as bad as a lot of things are, based on all the technologies we have and everything else, even some of the poorest people have things that couldn't even be imagined in the Middle Ages or even a couple hundred years ago, right? I mean, life has gotten better on average, right? Or Zcash, Larry, or something, right? Yeah.
XRP, Larry.
Oh man, don't get me started. Those bots come after me, I just want to die. I've never blocked so many people so quickly. And what I find with them is obviously it's similar to what you described, Bob, that they've been successful. It's worked for them. The system isn't hurting. I mean, yeah, sure, gasoline prices are high, but you look at their net worth, it doesn't move the needle for them. They're okay.
Right.
And yeah, a lot of bad shit's going on in society, but that's all those people's problem, not mine, until they're, get carjacked or home invaded, right? But they live in gated communities, so they can try and avoid that. There's no point of pain that causes them to think this isn't right, this is broken, I got to address it. And unless they just happen to be kind of curious and forward thinking, they generally speaking don't
see a problem.
They don't see a problem. And in fact, I belong to a group that's kind of like the one you and I do lunch with, a bunch of senior guys who've been very successful. And And it was very obvious to me. One of the guys I gave my book, who'd been extremely successful, read it, and it really pissed him off. I mean, criticizing the Federal Reserve, because, it in the way that it would piss off a Charlie Munger or a Warren Buffett. Do you know what I mean? And he'd won the game, and in his view, he'd won it fair and square. And anybody who was claiming the game was rigged and that his gains were not justified, that made him angry. I gave my standard response, go fuck yourself.
Lepard argues that Bitcoin offers an alternative monetary framework. Unlike fiat currencies, Bitcoin has a fixed supply. No central bank can create additional Bitcoin. In a world where governments repeatedly respond to crises through money creation, scarce assets become increasingly attractive. He sees Bitcoin, gold, and silver as beneficiaries of this trend because they cannot be printed into existence. Lepard believes many people underestimate the significance of this distinction. Most investors have spent their entire lives inside a system where currency supply continually expands. They have never experienced a truly scarce form of money. Bitcoin changes that. For the first time in modern history, individuals have access to a global monetary asset whose supply schedule cannot be altered by politicians or central bankers.
Inflation really shouldn't be measured in terms of any one spot set of prices because they have supply, demand, and Strait of Hormuz closed pieces to it. Real inflation, the correct definition of inflation is the growth of M2, the money supply.
Correct.
The money supply represents the claims on all the goods and services in the world. And so if you keep the money supply flat, you shouldn't have any inflation. It should average out over time. Prices will go up in something because there'll be a shortage of it, but that's not inflation.
And most likely it went down in something else that you didn't pay attention to.
It'll all balance itself out.
Right.
But the money, and what you see, if you look at global M2 since, for the last 20 years, it's been going up and to the right. But more recently, it's actually been going up even more rapidly. And it's interesting, the U.S., I read this recently, the U.S. money supply is going up at about 4.8% a year, which is a little higher than our recorded inflation. The Chinese are actually inflating very heavily. Their money supply is growing at about 13% a year. And that's because they've got a lot more economic growth, a lot more credit creation, a lot more debt creation. Japan is probably, it's the most indebted country in the world, has higher debt to GDP even than the United States. They were the leader in establishing QE. They did it before the United States did it, and they suppressed their bond yields. I mean, as we all recall, maybe some don't, but Japan had an enormous bubble in the 80s. And in 1989, one listing on the Tokyo stock market was worth more than all the real estate in California. I mean, it was just insane. What happened is when that bubble burst, the Japanese financial authorities realized they had a problem and that everything was going to collapse. And so they took interest rates to zero and they started buying their own bonds. So they established the two policies, and this was in 2000. This is long before Ben Bernanke did it. So they established the two policies that became the underpinning of how to grow economies when a bubble has burst. And those two policies were take interest rates to zero interest rate policy, ZIRP, and purchase your own bonds with newly issued currency. So effectively dilute the value of your currency and suppress your interest rates, holding what we would call in the US yield curve control. Hold interest rates down. And in general, one would think that those two things would be highly inflationary, but to have inflation, you have to have a spark. You have to have, demand going up. And in the Japanese example, they were a net exporter nation. They were a nation of savers. So all those savers put up with it. And they managed to have that policy for years and years and years. And eventually what happened, though, and what's now happening is, and as a result, part of the whole way the financial bubble that we now exist in the United States, and I do believe we are in an everything bubble right now, the way that whole thing got blown is via something called the yen carry trade, where people would go to Japan, they would borrow money in yen, they borrow it at almost 0%, and they would convert that money into pounds or dollars or something else. They would invest in something that yielded money, and they essentially would get a very high rate of return, almost an infinite rate of return on their capital. And the only way they would lose is if the Japanese yen declined greatly or if Japanese interest rates went up. And for many, many years, because of the construction of the financial system, neither of those two things happened. But now they're happening. And the fact that they're happening, I mean, the Japanese yen is now almost at 160. If you put up a chart of the Japanese yen going back over a long period of time, you'll see it's been losing value. And so Once those two things start to unwind, Japanese yen starts to lose value and or Japanese interest rates start to go up, your big source of free money in the world, which has been Japan for many, many years, goes away. And as that happens, things break. Because in a credit-based system, the monetary supply has to continue growing or else it collapses. But the point is that these things become problematic when the cost of the money goes up and the interest rates go up. And that's what the bond market tells you and warns you of. This is the debt doom loop that is described in my book, and many others have described it. James Lavish has done a great job describing it. Your government runs a deficit. They have to finance the deficit by issuing debt. They issue debt into the marketplace where the interest rate is set by supply and demand. More debt being issued implies more supply, so the interest rate would go up. Then your government, which has a lot of debt, has to pay more money on all the debt they have because the interest rates are higher, so the deficit gets bigger. So now the bigger deficit means they got to sell more debt. So the additional debt they got to sell into the marketplace, again, pushes the rate even higher still. And it's a self-reinforcing negative loop that eventually leads to either interest rates skyrocket to address the problem and stop the inflation and the credit growth. That's what Volcker did in 1980. He took rates at 20% and shut it down cold. And he was able to do that. I mean, and even then, still, I mean, there was some guy walked into the Federal Reserve building in that time frame with a shotgun, wanted to kill him. You know, and it's a true story. And the farmers were, you know, riding their tractors east saying, you know, you guys are wiping out my farm. And my dad's business almost went out of business because he was carrying a bunch of inventory and paying 20%, you know. So controlling these inflations with high interest rates is very hard. And that was when we had debt to GDP of 35%. Right now, debt to GDP is 123%. So the notion that we can stop this inflation with higher rates is just a joke. If we took rates to 10% right now, the entire world would go bankrupt. Everybody, you know, we would have a Great Depression. So the alternative is what they have to do is they have to bring the rates back down. Well, how do they do that? They do it through yield curve control and quantitative easing. And so quantitative easing is where they say, all right, we are going to actually issue new currency, or in the form of bank reserves is how they do it, to the banks. The banks are going to then be able to issue loans to businesses and grow M2, and it's going to be used to purchase bonds. And so they're going to enter the marketplace and buy bonds, and that additional source of demand for the bonds will bring the interest rates back down. And this is what they did. This is not new or untested. This is exactly what they did in World War II. So in World War II, we went from a low level of debt to GDP pre-war, and the Fed balance sheet went up 10x during the war. And the reason it did is they set the short-term rate at 3/8%, and they set the long-term rate at 2.5%, and they said, have at it. And so, and they went out and they marketed Liberty bonds and said, you know, buy bonds, support America. And Americans were patriotic, and they bought those bonds. They got killed because there was enormous inflation during the war and after the war, but everybody did it as part of their patriotic duty, you know, to buy these bonds. And they weren't able to unwind that until like 52, you know, when they had a new Fed Treasury Accord. So, you know, basically, this will have to be done again because of the math, you know, where the big print one was GFC, the big print two was COVID. Each one got bigger and faster. The big print three that I talk about in my book is the next one, and it's going to be even bigger and even faster. And so at some point in time, they are going to lose control of the bond market. And that's what keeps, you know, my hair on fire at night, is watching the bond market. And right now, I mean, literally right now, they are losing control of the bond market. You know, look at the slope of in Japan. Mm-hmm. In the US, they're kind of close to losing control. In the UK, they've lost control. Take a look at the shape of the same story. It's going straight up. And so these bond markets are the tell that the monetary system is under stress and is about to really have an event that requires a big print. They did it in 2008. They did it in 2020. Here they are. They're doing it in 2026 or maybe 2027. The next one will come at some point. And that starts the process of what I call Gresham's Law. Once you realize you're holding something that will never hold its value, you say, sorry, I don't want to hold this anymore. And so you sell it and buy something they can't print, which is gold, silver, and Bitcoin. And so, you know, I think on the next round of yield curve, if the Fed were to go in and say, look, for reasons of growth and keeping the system together, we are going to lock the 10-year at 2.5%. And we're going to lock the 6-month bond at 0.3%, very much like they did in World War II. And we're going to do this indefinitely. My sense is what would happen is the U.S. bond market would turn around and say, okay, sold to you. Hang on a second. You mean to tell me this thing that I thought was going to, inflation's running 7 or 8. We all know that. And you want me to hold this bond at 2.5% when inflation's running 7? No, I'm not doing that. You're stealing my money. So here, Fed, buy it. You can have it. That's going to take the Fed balance sheet from 6.6 to 14 or 15. And that's going to take M2 from like 26 or something to 45. And inflation's going to rip. I mean, just like it did after World War I, just like it did after World War II. And eventually, it's going to rip so hard and so fast, everybody's going to realize they're in a burning theater and they got to get the fuck out. This is where the power law breaks to the upside. Power law, I think, is a great model for modeling the Bitcoin price, but I think it'll eventually break to the upside. Because if you, and I say this based on just human psychology and other hyperinflationary events, and when everybody knows that the currency is losing value, everybody wants out of the currency. I mean, this is what happened in Venezuela. This is what happened in Weimar Germany. This is what happened in Zimbabwe. This is what's kind of happening now in Turkey. It happened in Russia, the German mark, World War II, when they lost the war, that became worthless. Same with the Japanese yen. They lost the war, they printed money, the yen was worthless. They had to start over again. So this is what will happen. We just don't know exactly what the shape of the curve is, and we don't know exactly what the timing is. But we can see the movie, laid out in front of us. We do know it's coming.
One of Lepard's boldest predictions concerns Bitcoin's long-term trajectory. He argues that current valuation models may underestimate what happens when confidence in fiat systems deteriorates rapidly. In normal market environments, Bitcoin often follows predictable adoption curves in power law models. But during periods of severe monetary instability, human psychology changes. People stop thinking about investment returns and start thinking about preserving purchasing power. Lepard points to historical examples such as Weimar Germany, Zimbabwe,
Venezuela,
other currency crises. In each case, once confidence broke, citizens rushed to exchange their currency for anything that could hold value. He believes Bitcoin could experience a similar dynamic on a global scale if major economies continue down the path of excessive debt and monetary expansion.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.